Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Hey, everybody. Welcome to another episode of the Major League Real Estate Podcast. I've got my co-host, Matt, with me. Matt, how's it going? You got any fun plans this weekend?
Yeah, I'm going out to visit a friend in St. Charles, which is a city slightly west of St. Louis. It's like a kind of a historic area, so we're going to go hang out in their downtown district. So it'll be a good time.
Nice, awesome. If you guys are watching the YouTube video, you can see my Thunder hat, Thunder up. So this episode might come like a week late. So hopefully it's a good result tonight, as I'm going to watch the game with not actually at the stadium. I'm going to go watch in OKC Stadium. So hopefully it's a good outcome for me tonight. If you're a Pacers fan listening, I apologize. If you are indifferent, hopefully you're going for the Thunder. We'll see what happens tonight. It's a fun time in OKC basketball. But to what everyone is listening for today we're going to talk about what is depreciation. What is depreciation? What do you use for depreciation? Right? A lot of times we get questions. People, honestly, we find more times than not, even other CPAs think they understand depreciation and what it is, how it interacts. And I think it's always good to take a couple steps back and just be like, hold on, we should do a deeper dive of what this means. Because it does really matter for syndications depreciation. It's massive, actually. It's like we should never make decisions based off of only depreciation and tax losses, but it is one of the large benefits to investing in real estate because you can avoid a lot of taxation on it through depreciation, right? So a little bit of spoilers, what we're talking about here in a little bit. But Matt, in your opinion, why is depreciation such a big deal in syndication? What's so important about it? And I guess maybe start us from the beginning is how do we even figure out what depreciation is on an asset?
Yeah, so depreciation is very simply whenever a taxpayer, so this could be an entity, could be an individual, really any taxpayer that purchases property, whenever that property is placed in service, you can effectively deduct the cost of that property over a specified period of time. And it's really just a method of cost recovery. And what I hear a lot of times is people often say that depreciation is a way of tracking the wear and tear on the property and the value of that property going down. And that kind of works in theory. But the issue, and I think everyone kind of collectively understands this, but the value of real estate, generally speaking, doesn't go down unless something has gone sideways or there's some sort of market event that would cause that. Obviously, property deteriorates, but generally speaking, property values remain steady or increase over time. But going back, that depreciation, it's really just a matter of being able to, on your tax return, deduct a certain percentage of that cost every year over a certain period of time, generally speaking, 27 and a half years or 39 years, depending on whether the property is residential or commercial.
Yeah, thanks for that, Matt. Yeah, that's the biggest takeaway is that, hey, you're getting a deduction on something that's also simultaneously appreciating, right? Hopefully we don't get a 2008 event. And that's hopefully everyone wants to avoid that for sure. But it's you're getting a tax deduction simultaneously as your property is increasing and your equity increases more than likely as well. So it's a very tax advantageous asset to invest in. That's why it's so popular with everyone. So how do we figure out the depreciation number? How do syndicators get to that? What's involved in that process? And how do you help syndicators figure that out?
Yeah, that's a great question. So whenever you purchase a property, it's made up of multiple components. At its base level, it's made up of the actual land that you own and the improvements that are built on that land. So the building, any structures, any land improvements like a parking lot or all of that, that's separate. Land on its own is not depreciable. You cannot depreciate land. You don't get any added tax benefit for that land component specifically. So the first step is determining what percentage of the property is related to land and how much of it is attributable to the improvements on the land in terms of actual dollars allocated based on the purchase price. So that's step number one. And oftentimes this can be done via an appraisal. Usually when the property is appraised, they'll split that out for you. And in the absence of an appraisal, what you can typically do is you can actually just go into the county website and look up the property tax value. And All property, generally speaking, across the United States is assessed by the county assessor on some period of time. It could be 1, 5, 10 years. I don't know. It depends on the county.
Mhm.
But oftentimes, in the absence of an appraisal, you can use that assessor's value of land versus improvements as a split for determining how much of that purchase price is attributable to each of those two components.
Yeah, no, it's the biggest piece that I feel like a lot of people forget about is they just look at the purchase price of the property and they go, oh, cool, well, that's so much depreciation. And like, then you go, oh, by the way, you own a property in California and 60% of and per the county assessor and all appraisal sites, 60% of your purchase price is allocated to land. And so then it's like, oh, wow, you actually don't get to take nearly as much depreciation as expected. It's a really big bummer. So like, I'm not saying don't invest in California, but if you were looking for a lot of depreciation, it's probably not the best place to go invest. Now, I'm definitely not giving investment advice or anything like that. But if you're looking for large depreciation deductions, if it's a multi-million-dollar property, you can still make it happen, but it's just going to change the overall allocation when it comes to that land, right? And a lot of this stuff is done, like Matt was saying, is like during close, these kinds of appraisals can be done and are looked at. So you don't always have to rely on the county assessor. I've had a couple of times where the county assessor said one thing, but then they purchase a property and it's like, I was like, hey, I'm sorry, the land value is not advantageous. So we'll hold on. Here's what this says. Can we go with that? And I was like, oh, absolutely. Yeah, we can go with the better piece there. No, thanks for that, Matt. And so in tax, we use this word capitalize and then depreciate. And like, how does that factor in to this piece of the conversation? And how does that matter? And what should limited partners or even general partners understand about this?
Yeah, so the term capitalized really just means to take a cost and deduct that cost over a period of time rather than deducting it all at one time as a one-time expense. That's the difference between expensing something or capitalizing something. You might hear those two terms thrown around when you're referring to improvements on a property. But simply put, to capitalize something really just means to add it to the depreciation schedule as a depreciable asset that will decrease in value over time, and you would pick up these depreciation benefits over time as the addition is depreciated.
How do things get added to the depreciation schedule? How does that even happen? What does that even look like?
So whenever you have improvements on a property, so let's say you purchase a property, but then you completely gut it and you remodel a whole bunch of stuff. Whenever you have an expense that is over the de minimis safe harbor, which is $2,500, and the de minimis safe harbor is the safe harbor the IRS allows property owners to utilize when they're making improvements and repairs to the property. It's an election you have to make on your tax return, and your tax preparer should be making this election so that whenever there are repairs, let's say you're replacing something really minor and it's only $1,000, you can just deduct that as a repair expense and you don't have to worry about capitalizing it. That's the threshold whenever you hear the term de minimis safe harbor thrown out. That's what that's referring to. But anything over that, there's a series of other tests we can get into maybe a little bit later about whether or not you can expense or capitalize something. But if it has to be capitalized, if it doesn't pass those tests, that's when it gets added to the depreciation schedule.
Yeah, that's fantastic way to put that. The way I like to think about it is essentially like when you purchase a property, right? That's your initial basis. That's your initial depreciable basis. After that, we figure out what's going to be done after that. And a lot of times, I know people ask this question a lot. It's like, what in my settlement statement can I deduct, or is it all capitalized? And you tell me if you agree or not. But pretty much 99% of the costs that you incur at close or that are involved on your settlement statement, those are going to wind up being capitalized. And those are going to be added to your depreciable basis over the lifetime of the asset. And 99% of the time, when you're purchasing a property in a syndication, it's more likely or not going to be a 39-year type asset, right? That's not always the case. It comes down to, is it residential or commercial for the most part? Commercial, if it's a shopping square, something like that, or if it's an apartment building, right? If it's an apartment building, that gets depreciated over 27 and a half years, while the commercial building, that'll be 39 years, right? So it's like two different places there. And it's like, what makes that determination is basically like, most of your rent, is it coming from people living there, or is it come from people just using the space for stores, office, whatever, right? That's kind of what it comes down to. Any other thoughts on that?
Yeah, no, I would agree. Generally speaking, all of the costs incurred to close on the property and acquire it on the settlement statement are all baked into your initial tax basis in the property. The only key exception there would be any loan costs or any costs you pay to the bank for the purposes of acquiring financing to purchase the property. Those are also capitalized, but they're actually amortized over the life of the mortgage versus depreciated over the life of the property.
Right. That's an excellent point. Yeah. It's like what's amortization, what's depreciation? They're basically the same thing, except like depreciation is a physical, the exhaustible wear and tear of an asset, while amortization is like, hey, it's like we can't really grab the loan costs out of like can't like physically hold that where you can grab the brick from your building. So it just means that like, hey, it's kind of a fake expense for tax purposes that you get to take. But it's a great point because the loan costs can be pretty high in some cases. And that means depending on the life of your loan, maybe it's 30 years, maybe it's longer, maybe it's more likely not. In the business terms, it's probably going to be a lot shorter. I mean, what do you generally see in that from your syndications that you deal with?
Yeah, I mean, usually for larger syndications, those loan costs could be north of $50,000. I mean, depending on the size of the mortgage and how leveraged the property is. Generally speaking, I see a lot of 30-year mortgages, but more recently I've been seeing a lot of shorter term mortgages, 15, 10 years, or even like 5 years with a balloon payment, and everyone's just banking on refinancing. With uncertainty in the interest rate market right now, it's really there's a lot more variance in what we're seeing. Back in low interest rates, we were seeing almost every single mortgage locked into 30 years, and that was very common. But now things are changing. But like you said, that amortization is taking over the life of the loans. So however long that loan period is, that's how quickly those costs are recovered via
Yeah,
amortization.
actually, like not to ignore the tax piece, but what are you seeing? And like when it comes to like the rates and like debts that you're currently, it sounds like kind of like you're seeing a lot of shorter lifespans right now. Anything with like in the bridge debt space that you're seeing? I know, like unfortunately, we always hear the news about this real estate syndication went bust. That real estate syndication went bust. The big ATM syndication with Zook that is still ongoing discussion in bankruptcy. Like anything that like you're seeing specifically.
Yeah, just a lot of shorter term mortgages. And a lot of my clients are taking sort of wait and see approach with the intention of refinancing every handful of years until the interest rates head in a direction that they want. With rates being still north of 6-7%, it's not an ideal situation, and obviously you run the risk of trying to refinance in 5-8 years, and rates are even higher. But I think most people are expecting those rates to come down within the next 5 to 10 years, and that's kind of what I'm seeing people bank on.
Yeah. Okay. No, that's a super great insight there. Real estate syndication tax is confusing to you. Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. So just kind of recap real fast. Talked about how do you figure out what depreciation is, right? So like that's what Matt's doing. He's working with these syndicators to then figure out what the depreciable basis even is, including their improvements or any work they've done on the property. Because one of the most important things I think people forget about a lot is that anything you do before a property is placed in service now doesn't happen for like active rentals or things like that, but anything that's like placed, taken out of service and needs, let's say, a massive remodel. Let's say it's a pretty worn down piece of property, or maybe you got it whether an auction or foreclosure or something like that, and they do a ton of the improvements. That's all capitalized. We don't actually get to expense that, unfortunately. And so pro tax is like, hey, you don't have a business yet. You really don't have a business yet. You don't have any people living here. So you have to capitalize all that. And then once okay, great, we're ready to rock and roll. Tenants can come move in. It's livable now. We got rid of all the black mold or whatever. And so now you got to begin taking depreciation. You see that catch clients unaware a lot.
Yeah, that's something that we talk about a lot, and something that you kind of have to explain when people are planning out these renovations in advance. So, what does it mean for something to be placed in service? Generally speaking, it means that the property needs to be, let's say, legally inhabitable and marketed for rent. So, if you have an ad listing that, like, this property is move in ready, you could pay me rent today and move in right now, then that property is placed in service. If you're not at that point, the property is not placed in service yet. So that's really the key distinction. And oftentimes you'll see during tax planning, people will really push to get that property to a placed in service state before year end. So that way you can place the property in service for that specific tax year. And if there's any bonus depreciation that you'd be able to recognize, you would get all of that in that tax year versus the next tax year whenever it's placed in service.
Yeah, it's always something that like I see a lot with my clients too. So it's like, oh great. It's like I got it all done and ready. It's like, okay, great. Is it like could someone like was it marketed? Could someone have like walked in from the street, like you had the sign up, walked in from the street and said, I'm gonna stay here tonight and be like you'd be like sold. And a lot of times it's like, oh well no, I had to do X, Y, and Z or this had to happen. It's like, well, then like it's not really placed in service, unfortunately. But hey, if like you've got it listed, you've got the for rent sign and someone pokes their head in and goes, "Can I stay here?" And you go, "Yeah, no problem." That's when I would consider to be placed in service type of thing. So that's a really great point.
Yeah. One other kind of thing to add to that is with commercial property. One thing that's an important distinction is often if you're bringing in commercial tenants or business tenants, the property oftentimes is not necessarily move-in ready because you would need to add tenant improvements to that property before they could occupy the space. But it's at a point where it's ready to show, people are coming to see it, it's marketed, and they could sign a lease today with the intention of doing those tenant improvements after the fact. That still counts as placed in service as long as you're legally able to get a lease signed and placed in service today.
Yeah. Matt, now that you mentioned those improvements, actually, let's take 2 steps back and talk about accelerated depreciation and how we even get to that, right? So we talked about depreciation and we talked about depreciation. So basically, when we mentioned already, there's 2 types of depreciation, 27 and a half and 39 year for the most part for big buildings. And there's also smaller categories, right? You know, a vehicle that's depreciated 5 years, and things that are like more equipment type. And then there's 7 years, which is computers. There's 15 years, which we call those leasehold improvements generally for the most part. There are odd categories that exist, right? Some things are like 10 years or whatever, but we won't necessarily talk about those today because they're not as applicable to real estate. They do exist, but how do we figure that out, right? So like when you buy a big building, right, there's a lot of components to it. And currently, like based on what we've said so far, you either depreciate 27 or 39. How do we get into these smaller buckets of categories and take those depreciation? Because I know a lot of times if you look at a depreciation schedule for a syndication, you'll see those categories. How do we even get there?
So, whenever you purchase a property is made up of smaller components. So, you just purchase this building, great. You could just go into your depreciation schedule and just say, this is the building, this is the value, it's depreciated over 27 and a half or 39 years. However, you can break that down to smaller categories. You could say, this is the roof. This is, the doors, the carpet, the flooring, the windows, the gutters, the HVAC. There's all these different components that make up the building, and each of those components have their own depreciable life. And this is based on guidance and information that the IRS and the Treasury Department have sort of disseminated out that outlines what type of property is eligible for what types of accelerated depreciation.
Absolutely.
And in order to break this out, sorry, go ahead.
No, yeah, absolutely. It's actually the preferred method because it's still considered real property, right? It's just getting pulled out. So it's actually the preferred method that is done. So a lot of people say, don't get a cost segregation study. The IRS doesn't believe it, but like there's like Matt was saying, there's an IRS audit technique guide. There is all that type of stuff that exists. And so I think it's like, I'm not saying it's a disservice to syndicators to not do this, but basically no one's going to get the depreciation they expect if you don't do a cost segregation study.
Yeah, and just backing up a little bit, what even is a cost segregation study? This is a service that you can get from a cost segregation firm that will come out. It's very similar to an assessment where they'll walk through the property or they'll get images of the property and figure out what percentage of the property is made up of the roof, the HVAC, all the interior components. They'll assign an estimated value to each of those individual components with the intention of telling you, all right, if you purchase this property for $10 million, 10% of that is made up of assets that are depreciated over 5 years. And another percentage is 15 years, 7 years, 39 years, 27 and a half years, whatever it may be. And what you can do is when you initially capitalize the value of the property, you can split up that value into those different buckets. So why this is important is because if you capitalize the same value, let's say you capitalize $1 million over 27 and a half years. Well, that $1 million expense is going to be deducted on your tax return over the next 27 and a half years. But if it's $1 million capitalized at a 5-year depreciable life, that means that you recover that entire $1 million expense over 5 years instead of 27 and a half years, which means that you are getting more tax benefits in a shorter period of time than you otherwise would have, which is why these cost segregation studies are so important.
No, 100%, Matt. Yeah, it's so valuable and crucial because of the bonus depreciation and the fact, like, honestly, like, actually, so like we were like talking about this beforehand, is that like bonus depreciation is like, I'm going to tell you this, and you guys are like, you're crazy, but it's only 20 years old in the tax code, right? And like, well, I'm like, let me say, the tax code's been around for a long time. It's been around for like over 115 years at this point, and so because of that, saying a 20-year-old provision is not that old is very true. And so, but now we got the nice sweet taste of 100% bonus depreciation for so long, and now we've slowly decreased, but it's still worth doing. And like even before bonus, it was a very valuable item to consider, not just because of 179 deductions that commercial spaces can take, but just because you get that accelerated depreciation that you can ultimately take, right? And so like there's a difference between 100% bonus and accelerated depreciation, like we're talking about, because you go from taking 39-year property and depreciating it over 5, 7, 15 years, and that's way, way, way faster than if you just got the deduction today, right? And so it's another big point to real estate to be able to do these types of things. And like Matt, I would love to hear what your experience is. I generally see buildings fall around between like the 25 to 35% of like what's actually eligible for bonus or accelerated depreciation. What have you seen in your practice?
About the same. It depends on the asset class and what type of property it is. I'd say for most commercial properties and multifamily that 20 to 30% is typically pretty standard. It obviously depends on the property, depends on the market. There's a couple of factors at play, but that's pretty standard. You'll see larger quantities of bonus eligible property at asset classes such as RV parks or mobile home parks, just because those properties aren't necessarily affixed to the ground. So that changes the calculus a little bit. But generally speaking, that 20 to 30% is pretty standard. And one other thing that I do want to mention, I don't know if we've touched on this yet, but whenever we were talking about breaking those assets into different buckets, that 5, 7, 15-year property, all of that property is what's bonus eligible. So that 5, 7, 15-year property, that accelerated property, that is eligible for bonus depreciation at whatever percentage the bonus depreciation rate is for that specific year. So it's changed over time. We're going to touch on that in a little bit, but that's the property that's bonus eligible. The 39, 27 and a half year property, that is not eligible for bonus depreciation, which is why these cost segregation studies have become increasingly important.
Absolutely. Here's a big benefit that I find, Matt, and I'd love to hear your thoughts on it too. But it's the fact that depreciation is so great, and it's because you can have a cash flowing asset, and basically, whether it's via cost segregation study or not, you can drive the taxable income of what's produced from that property to zero, and a lot of times greater than zero. And so that means the investors, the syndicators, the general partners are all getting the cash out of this partnership essentially during the time frame tax free. They're not having to pay taxes, like whether it's they're getting a check for $1,000 or $100,000, they're going to be getting at tax free. So basically, the way I like to think about it is that normally, whenever you're receiving money, the government goes, we would like 30% of that, right? That's the way I like to think about it. Whenever you do a transaction, they're like take at least 30% of that cut. In this example, that means that's 30%, $300 or $30,000 that you get to keep and do investments, et cetera, whatever you want in that instance. And that's a massive play and a massive wealth play at the same time.
Yeah, absolutely. But I do want to just kind of touch on the flip side of this. Depreciation is not an infinite money glitch, let's call it. It's at the end of the day, whenever the property is sold, all of that depreciation is recaptured. So depreciation by its nature is a temporary tax benefit. You're getting the benefit of acquiring and running this property up front, but later on when it's sold, you need to recapture the depreciation that you've already taken in the form of income. And one way I like to think about this is just quite simply, whenever you purchase a property, your tax basis, very similar to purchasing a stock, right? You buy a stock, you have your basis in a stock. Let's say you buy a stock for $10, your basis is $10, you sell it for $20, you have a $10 gain. Very simple. Real estate, very similar, a little bit different. Let's say you purchase a property for $1 million. Mm-hmm. Your tax basis is $1 million. And let's say you recognize $500,000 of depreciation over a period of 5 years, let's call it. So now your basis in the property is only $500,000. And if you sell it for $2, now you have a $1.5 million gain versus just a $1 million gain because you have to recapture that depreciation that you've taken. So that's effectively what depreciation is doing. It's just changing the calculus of how you would calculate that gain on the back end when you sell the property. So it's not a permanent tax benefit. It's a timing difference, and it's important to recognize that.
Absolutely, yeah. It's like a lot of people forget about that. Like there's a lot of people don't think about that at all, and it definitely is something to think about. But and like some people go, oh, so I should never do a cost segregation study. I should never accelerate my depreciation, and I would actually disagree with that. And the reason why is because time value of money, right? If you do a cost segregation study and you're saving today's dollars, and sure, maybe you have to pay tax on tomorrow's dollars. Guess what? Tomorrow's dollars is 5 years from now. We can figure out 5 years from now. We can do tax strategy, tax planning 5 years from now. And guess what? If you got let's say $50,000 because of this tax free, that's $50,000 that you got to utilize and invest, et cetera. That's more valuable than what you would get 5 years from now. So all in all, it's still super, super valuable in my opinion, right? You still have to deal with depreciation and recapture. And so basically, like Matt's saying, normally when you sell an asset, when you sell that stock, it's actually taxed at capital gains rates, right? Max 20, 23%, right? We'll say 23% for now. So that's the very advantageous provision. However, once you sell the property, that's when it gets when Matt's saying gets recaptured. It's recaptured at ordinary income rates, right? So unfortunately, if you're stuck in the 37% bracket and this happens 5 years down the road, you might get hit with a good chunk of that depreciation at ordinary income rates. So while the 37 straight line depreciation is taxed at a max 25% rate or whatever your capital gains rate is, more times not, it's 25%. And then whatever's left over, so like Matt was saying, if you took $500,000 of depreciation, you have $1.5 million gain, $1 million is probably going to be taxed at capital gains rates. The rest of it is going to be taxed at that ordinary income rate, right? So like you get a deduction today, but you'll have income tomorrow. Now, there's ways we can mitigate that, whether it's 1031, qualified opportunity zones, right? Those are episodes for another day, but there are strategies we can use to mitigate that. So Matt, anything else that you can think of that we should cover when it comes to depreciation and recapture?
No, I think you really hit the nail on the head there, because the important piece of that is what I like to call the flavor of income.
Wow. I'm stealing that. That's amazing.
Yeah, no, it's fun. You can think of each type of income as a different flavor of ice cream. There's ordinary income, capital gain income, all kinds. Yeah, that's the phrasing I like to use. But there's different flavors of income, and it's really important to recognize that whenever you're looking at a potential sale or a potential capital transaction. It's really important to consult with your tax advisor, your CPA, to run the numbers on what that gain will look like, because it's quite possible that the gain that you have in your head might not entirely be a capital gain. Maybe there's different amounts that are subject to different tax rates. So it's just really important to understand that before you begin to sign on the dotted line on some of these transactions.
100%, Matt. Speaking of 100%, so one big news that real estate investors very much pay close attention to is the state of the current tax bill. The one big beautiful bill, as it's currently named, or the OBBB, short name for it. And I guess where we're at with that right now. And basically, we have a chance to get back 100% bonus depreciation, which is like, Matt, I'm sure many of your clients have been paying attention and have asked a lot of questions of what's going on there.
Oh, yeah.
So where do we stand at today? Before I go into that, I just want to say that we have a weekly newsletter. It's actually daily, but weekly we give you updates on where the tax bill's at. So just go to www.therealestatecpa.com/subscribe if you want to be a part of our newsletter. So where do we stand at today for this bill? And why does it matter? Because right now in 2025, we are stuck at 40% bonus depreciation, which is a little pretty unfavorable compared to what we've had in the past, right? Because we've had 100%, 80%, 60% over the past couple of years. And while it's like still more advantageous than what we had previously, which was like the highest we ever got to is 50%, 40, like we are kind of in this unfavorable position currently. So what they're trying to do is pass before the end of this year is that we will get 100% bonus depreciation back to us for any assets placed in service in 2025, with a small date caveat stating it has to be acquired and placed in service in 2025. So unfortunately, a lot of you developers out there who are in the middle of a construction, where maybe you started in early 2024, or even late 2024, unfortunately, a lot of that isn't going to qualify, right? So if you broke ground on January 20th, you're going to qualify for 100% bonus. If you close and all your contracts were finished and signed on January 31st, and that's when you own the property, you're going to qualify for 100% bonus. If you did any of that, had any contract, anything like that before then, unfortunately, that's not going to qualify. So that's the one negative with this bill. We'll see if that gets modified or changed. And so right now, the bill has gotten through the House of Representatives, and they've passed their portion. And so now it's sitting in the hands of the Senate. And the Senate is honestly trying to, I call it a speed run. They're trying to speed run the bill through their committees right now. They're trying to get this done as fast as possible because they want to hit the deadline of basically July 4th. Now, we're starting to realize it's probably a little unreasonable because they haven't even released the bill text yet. And so Senate Finance Committee will have to release their text, which they might do at the time of this episode on Friday, 6/13. It's probably looking a lot more like Monday at this point. We'll see what they ultimately do. One thing that's super interesting that they have included in this, and they're promising to want to have, is have permanent expensing. And in politicians' words, that means 100% bonus depreciation permanently going forward. So going forward, there'd be no fall off, there'd be no scale off. Right now, the bill's written, we get 5 years, 2025, 26, 27, 28, 29. After 29, we go to 0% bonus depreciation. But the way the Senate's writing it and the change they're going to make is they're going to put in 100% bonus depreciation here. So that would be massive. It's great economically. Economists love hearing that. They think it's a great driver of GDP. So hopefully that remains in the bill and can stay in the bill. The big issue is the bill after, let's say the Senate passes this, no problems, no issues, they get it out and done. It then has to go back to the House because they made modifications to it. So I don't know if any of you are paying attention. The House is a little messy. It's very much a very chaotic mess.
End of the century there, Nathan.
Yeah, right. It's like the House of Representatives has always been a very messy body of legislature. And they now have to go back and they'll have to get them to say yes to everything, which good luck because they tried doing that the first time around and then they had to give up a lot of stuff to get everyone on the Republican side to sign, right? And so hopefully permanent bonus depreciation can stay. That'd be fantastic for our clients tax-wise. And I would love to see that happen. I would fully expect it's just going to be 5 years. That's really my expectation at this point. I don't think they'll make it work. Hopefully they do, but that's where we stand right now. The July 4th deadline that you probably heard about for this bill is probably unrealistic. We're probably looking more like July or August for an actual signing from the president at this point. However, that's still better than December, right, Matt? That's significantly better. You can actually plan with your tax clients and what's going on there. So, Matt, how do you think that this can be useful or helpful for clients?
Yeah, so one thing that I do want to touch on, just to get some clarity, I know in the past when the House was initially negotiating the bill, they mentioned that the start date for 100% bonus depreciation would be, I believe it was January 20th, 2025 instead of January 1st, 2025. Is that still in the bill as we're looking
as of right now? As of we're talking at this moment, the Senate Finance Committee has not released their text. So they could definitely change that date and backdate it and not have that arbitrative date. I will not tell everybody what that date means, but I'm sure you can figure it out on why that was put in there. So we'll see what happens if that's left or not. But ultimately, I do think 100% bonus is going to return. The exact form or fashion it comes back, that's yet to be seen.
Yeah, absolutely. I mean, that's going to just be a big planning component for our clients. Obviously, the start date is passed, so there's nothing that can really be done if there was a property placed in service in January, February, whether it was before or after that date. Nothing can be done about that at this point. But as we're looking forward, just whatever the framework is for bringing that bonus back is going to be huge, whether or not that's 100% starting in 2025, 100%. If it has like a decreasing rate again going into next year, that would force people to accelerate the rate at which they're placing properties in service in 2025. So there's a lot of stuff up in the air, but this is at the forefront of the conversations I'm having with all of my clients for sure.
Yeah, so we'll just keep appraised. Follow us on socials, follow our newsletter on our website. We have, if you just search, you can do it in ChatGPT, you can do it in Google, whatever works best for you. Just search Hall CPA Bill Tracker 2025. We are providing updates every time there's a big piece of movement that happens. We got something written up pretty shortly after it comes out and blast it out to everybody so you can all read that. So just sign up there. You'll get access to clicking on the bills as well, right? We're making sure we're uploading whatever text there is. If you have interest in looking at it or reading it, that's also on there. But that's going to be the best way that you're going to keep appraised with everybody. All right, everyone. We talked today about depreciation, what's great, why everyone gets to utilize it. Next episode, we're going to talk about how you allocate that in a partnership because It's not as easy as it sounds on its face. And it's actually probably, in my opinion, Matt, tell me if you agree, is the most complicated piece of tax out there.
Yeah, I would argue that partnership taxation, specifically how to allocate gains and losses within a partnership, is, I would say, easily the top three most complicated sections of the tax code. It's, I would argue, arbitrarily complicated just through a series of, pieces of legislation laying on top of each other over the course of decades, just making things increasingly complicated. But yeah, no, it's going to be a fun topic to dive into.
Yeah, so if you guys want a full breakdown and want to walk away understanding it, at least a little bit more, tune in next week. Major League Real Estate Podcast. Thanks, everybody. Talk soon.